far in this module, we've looked at the basics of trading, from buying and selling through to the costs we can expect as traders. This lesson is about brokers.
You've heard me refer to brokers quite a bit, and I appreciate that I haven't spent any time actually telling you what they are, how they operate, and how to choose one.
Okay, enlighten us, Phil. What is a broker?
As a trader, your broker is your access point to the market. Without one, you won't be able to trade. So they are pretty important. Essentially, they are financial service businesses.
Okay, just so I'm 100% on this. When you say financial service, you mean trading?
Yes, the technical description of the service is called retail derivatives, but to you and I, that's trading. However, there is an important difference in the services that some brokers provide. Some are advisory, but a large majority are execution only. This means that the former is allowed to offer advice and tell you what to trade.
That sounds useful.
Well, actually, I disagree. As traders, we need to develop our own strategies and trade for ourselves. We don't want to rely on someone else to do this work for us. Advisory services normally cost a fair bit in terms of spread and fees.
Right, I see. So we only want execution then?
Yes, that is really what our courses are about, teaching you how to trade. Execution-only brokers are not allowed to advise traders. They just provide the tools to allow them to trade and make their own decisions.
This makes sense. So, for example, when I use an insurance broker, they organise my insurance for me with another business. Is this the same thing with trading?
Not really. Not when it comes to retail derivatives trading. Brokers will nearly always be the legal entity you are engaging and transacting with. They don't organize the deal for someone else. The deal you strike is with them. Derivative brokers are likely to be either a market maker or what's called a matched principal broker.
What's the difference?
The main difference is when you place a trade with a market maker, they don't have to hedge it off into the market.
What does that mean?
Well, it means that they can take the opposite side of the trade, meaning if you profit, they'll lose and vice versa. A matched principal broker is not allowed to do this. Instead, they must hedge the trade with another counterparty in the market. They are matching the principal.
Is one better than the other?
Not really, not in the UK at least. Market makers tend to be financially bigger because they are running more risk. But both types are required to meet similar regulations. This includes adhering to important regulations such as keeping clients' money safe.
I see. So you mentioned regulations. How does this work?